maximum employment, and price stability. Today, in support of these goals, the Federal Open Market Committee kept its policy interest rate near zero and stated its expectation that an increase in this rate would soon be appropriate. Turning to, more of the details that you're asking about, I would say this: the balance sheet is much bigger. It has a shorter duration than the last time, and the economy is much stronger, and inflation is much higher. So, and I think that leads you to, and I've said this, being willing to move sooner than we did in the last time, and also perhaps faster. But beyond that, it's really not appropriate for me to speculate exactly what that would be. But I would point you to principle number one, which is the committee views changes in the target rate.
You get inflation to 2%. Do you want to go below 2% so that on average you get a 2% inflation rate? And because you said we have to protect the employment part of your mandate, is there some sort of circuit breaker that would stop you from raising interest rates on the employment side?
So no, there's nothing in our framework about having inflation run below 2%. So that we would do that, try to achieve that outcome. So the answer to that is no. What we're trying to do is keep inflation expectations well anchored at 2%. That's always the ultimate goal, and we do that in the service of having inflation. We get to that goal by having inflation average 2% over time. And if inflation doesn't average 2% over time, then it's not clear why inflation expectations would be anchored at 2%. So that's the way we think about that. What was the last part of your question?
I was asking if you're protecting the employment side of the mandate, whether there's some sort of circuit breaker there.
Nothing like that. I mean, I would say you have a tremendously strong labor market, and you have growth this year at forecast to be well above potential. I mean, people are forecasting growth. If you think potential growth is around 2, most forecasts are significantly above that for 2022, and that's even with policy becoming substantially less accommodative. So the labor market's going to be strong for some time. We ideally, what we're trying to achieve is inflation getting back down to 2%, and we're trying to do that in a process that accomplishes that will also leave the labor market in a very strong position. And no one really knows what that will take. Again, I would say that it isn't just monetary policy that's helping inflation get down. It'll be supply side improvements, and it'll be less fiscal impulse in all likelihood. So, but monetary policy will do our job. It is our job to get inflation down to 2%, and a situation where the two goals can be in tension is a difficult one. But I don't really think they are here, though, because I think a really significant threat to further strengthening in the labor market in the form of higher participation over time is high inflation. And also, high inflation is taking away the benefits of some of these large wage increases that we're seeing now. So we do hope to achieve, and our plan is to achieve both of those goals. The slope of the yield curve, but we don't control the slope of the yield curve. Many factors influence longer-term interest rates, but it is something that we watch, and you will know that from when we had this issue a few years ago. And we take it into account along with many other financial conditions as we try to assess the implications of all those conditions for the economic outlook. So that's one thing I would say. Another is currently you've got a slope, if you think about 2s to 10s, two-year Treasury to 10-year Treasury, I think that's around 75 basis points. That's well within the range of a normal yield curve slope. So it's something we're monitoring. I don't think of it as some kind of an iron law, but we do look at it and try to understand the implications and what it's telling us. And it's one of many things that we monitor.
Can I follow up real quick and ask if it did invert, would you tie it to U.S. fundamentals, or would it be driven by a much broader set of factors?
That's a good question in real time. Obviously, U.S. long-term sovereign debt is an important global asset, and the fact that our rates are so much higher than other risk-free sovereign rates around the world may put something of a ceiling on our rates. I don't know, but it would really depend on the facts and circumstances at that time. And what I can tell you now, though, is that we fully appreciate that this is a different situation. If you look back to where we were in 2015, 16, 17, 18, when we were raising rates, inflation was very close to 2%, even below 2%. Unemployment was not at our estimates of the natural rate, and growth was in the 2 to 3% range. Right now, we have inflation running substantially above 2%, and more persistently than we would like. We have growth even in forecasts, even in the somewhat reduced forecast for 2022. We still see growth substantially higher than what we estimate to be the potential growth rate. And we see a labor market where, by so many measures, it is historically tight. I think in a way, the least tight aspect of it is looking at the unemployment rate, which is still below our median estimate of maximum employment. If you look at things like quits and job openings, as I mentioned earlier, and wages, you're seeing, and just the ratio of job openings to unemployed, you're seeing a very, very tight labor market. Now, we also know that labor force participation is significantly lower. It's 1.5 percentage points lower than it was in February of 2020. Maybe 1 percentage point of that is retirements. Some part of those retirements are related to COVID rather than just regular retirements. So we think there is a pool of people out there who could come back into the labor force, but it's not happening very quickly, and it may continue to not happen very quickly as long as the pandemic is on. So that's how we think about that. We haven't made, to your specific question, we really have not addressed those questions, and we'll begin to address them as we move into the March meeting and meetings after that. I expect the supply chain issues to be completely worked out by the end of this year. I do not expect them, and I have not expected them. What I would say, and I have been saying, is that I expect progress to be made in the second half of this year, mainly. Progress, because we're not making much progress. If you look at a ton of metrics, you can find some that suggest that delivery times are shorter and inventories in some industries moving up. But overall, we're not making progress. And things like the semiconductor issue they're going to be quite a long time. I would think they'll go more than through 2023. In terms of being too late, I would just say this: our policy needs to be positioned to address the full range of plausible outcomes, as I said, and particularly the possibility that inflation will continue to run higher, more persistently than we'd expected. And we think we are positioned to make the changes in our policy to do that, and we're committed to doing that. And that's really where we are. In terms of your question about the size of rate increases, we haven't faced those decisions. We haven't made them. It isn't possible to stand here today and tell you with any confidence what the precise path will be. But as we work our way through this meeting by meeting, we are aware that this is a very different expansion, as I've said a couple times, with higher inflation, higher growth, a much stronger economy. And I think those differences are likely to be reflected in the policy that we implement.
Thank you. Let's go to.
Welcome to the Crypto Teacher. And guys, I come back with that video just to make you think. And we have Jerome in the house. And guys, as Jerome was speaking, what did we see? Yield rates go up, and then the stock market pulled back. Guys, these indicators are so important. The Fed has given us the same exact guidance that we wanted. And what do we know, guys? A main event is coming, because we know they should have raised rates in this meeting. They're going to allow inflation to run wild for another 6 months. They are going to raise rates in March, but guys, what did he already say? It's already cooked in. But we know for the next year and a half, the stock market is going to take big hits. It's going to be a lot of pain because they waited so long. They're going to end purchases in March. They're going to start raising rates in March and then start rolling off the balance sheet in July, and more interest rate hikes later in the year. So guys, we know exactly what they're going to do. This is a controlled collapse. And remember guys, we're in a global economy, and we know Europe is going to be following right behind us. And we know this is all done on purpose. This is a controlled collapse of America, the Babylon. So China, the dragon, can rise. The fourth industrial revolution is going to make its way in America while it's falling. And remember, the crypto teacher told you, because he knows. When it comes to the New World Order, it's all planned out. You have a wonderful day.
We're going to a different economy, and we're going to be learning more about that as we go. But clearly, we're learning that things can be done from remote locations. We're learning that technology can replace people even more than we thought.
We're not going back to the same economy. We're recovering, but to a different economy, and it'll be one that is more leveraged to technology. And I worry that that is going to make it even more difficult than it was for many workers.
In Silicon Valley, and my friends who work in technology know that what we did to the manufacturing workers, we are now going to do to the retail workers, the call center workers, the fast food workers, the truck drivers, and then even bookkeepers, accountants, insurance agents, lawyers, and on through the economy. So what happened to the manufacturing workers is a very clear sign.
This effort. And China has big plans for this. They intend to seed their digital yuan into the global environment by giving it away to visitors at next winter's Olympics. When they arrive at the airport, they're going to get yuan digital wallets. They're going to receive digital yuan. They're going to use it throughout their visits to Beijing, and then they're going to take it back to their home countries. They see this as a huge advantage. Why? Because who controls the underlying protocols, who controls the underlying standards of the future of money will control the future of money.
The most powerful person in the world is the storyteller. The storyteller sets the vision, values, and agenda of an entire generation to come. Steve Jobs. And guys, you know I truly believe in this. When you look at the New World Order, they're the storytellers. And that's the reason why I wrote my New World Order book. But guys, now it's time to change the current generation. And I wrote 3 kids books. You know, I love the Trinity because I understand the power that's in it. So I have 3 books. We have an opportunity to change the generation, to educate, not just me, but I want to show you that I take action on a daily basis. And I want you to take action on a daily basis. Whether it's your job, whether it's in your community, we have an opportunity right now to educate the masses. I posted this on my Twitter account. Please share, but this is a short clip of the 3 books. There's going to be a clothing line and action figures. Please get these books for your kids, nephews, cousins, friends, so therefore we can start the re-education now. Because as we see, the 4th Industrial Revolution foundation is definitely here. Robots, algorithms, drones, taking humanity out the picture. We have to re-educate. But let's get into the video.
Part 1. King Joshua and Drama Tam save the village. Part 2. King Joshua and Drama Tam save New York from COVID Stories 3. Part 3. King Joshua and Drama Tam goes to China.
It's mandatory to get part 1, part 2, and part 3 of this series. It's time to re-educate Generation Z.